Well, Indian hotels reported numbers, and it was second quarter, of course, was in line with what the consensus expectation was. So there's, of course, been weather, which has been a bit of a disruption. There was some travel disruptions as well, the festive shifting of the festive season. But also, Indian hotels has a lot of its inventory which is being renovated. So all of that leading to, good numbers in line with expectation numbers, but not a bumper quarter. Puneet Chhatwal is with us. He's Managing Director and CEO at Indian Hotels Company. Puneet, good morning. Great to have you with us here. Thanks very much. Just the basic numbers, Puneet, if you will. I think same quarter last year, there was the Taj Stats business was, in that sense, brought in. So there was a extraordinary gain for the same quarter last year. And that is the reason why that year on year, without adjusting for it, looks lower. And there's been some reportage around it. Just wanted you to address that, and then we will talk to you about the outlook.
Yeah, there was. Thank you, Prashant. Good morning, everyone. There was a one-off exceptional item of 307 crores, which, if you look at last quarter, creates an extraordinary profit. However, the underlying business showed improvement by 15 to 16%, despite 250 crores of investment that we have undertaken in the first half. And some has gone into the month of October. So now the majority of those renovations, I would say almost all of them except for 30 rooms at Taj Palace, Delhi, they're all done. So yes, you're right. Last year, Q2, by consolidating Taj Sats, we had an exceptional accounting gain of 307 crores.
And you're saying that bulk of the renovations is now behind. So third quarter will be, all this inventory will be in, and by fourth quarter it should fully normalize.
Well, I would like to use your words, Prashant. You mentioned bumper. Bumper quarter is always quarter three. Our hope as a sector and as a company, Indian Hotels Company, is that the next 60 days, nothing unforeseen comes our way, because typically the Q3 profitability is larger than Q1 and Q2 put together. So up till now, it's a good start, and we hope it keeps moving in that direction. Plus, our ability to charge would be higher with the renovated inventory that has come in.
Maintaining the double-digit revenue growth guidance for the full year?
Yes, it stands at double-digit growth guidance for the full year.
So morning, great to have you in. So since we all know second half of the year is so much stronger for your industry, right? We all want to travel and have vacations and there are weddings. So let's just talk about the outlook for the second half when it comes to, the average tariffs, room rates, and the occupancies. What are your projections for Q3, Q4 vis-a-vis last year?
See, Q3, Q4, if we keep maintaining the same kind of rate increase as you have seen in the first half, it's very good because the base level is very high. So that's where the operating leverage kicks in. So I think if we keep going at around 10% RevPAR or top line growth, I would not say RevPAR, but the top line growth, because of the F&B business, because of the number of weddings that are there in the second half is higher than last year, I think we should be able to get the double-digit growth for the full financial year.
And just to understand that, so what does that work out to at an absolute level, the average room rate across your portfolio right now?
With our growing brandscape every day, it would be fair to actually do it by brand. So
yeah, that's actually right. Yeah, let's go brand by brand. Actually, yeah.
Yeah, the brand which is the backbone of the company remains the Taj, and I think there we are looking at 16 to 18,000 as a pessimistic scenario, and a bit higher in an optimistic could go up to 20 in terms of RevPAR. And if with the Ginger brand we can cross 4 or 5,000 with the growing portfolio and footprint of Ginger, I think we would have done a good job.
And just the mix, sir, I'm talking about the revenue mix. How much would be purely Taj, and how much are the non-Taj brands, which are also growing, how much are they contributing? So what will your revenue mix be by the end of this year?
So this is another very nice question. It's never been asked before, so compliment to you for that. We have moved a lot of hotels which were downgraded maybe 10, 15 years ago back into Taj. So Taj revenue has gone up to more than 75%, and the rest of the hotel businesses and other businesses get to 25% of the revenue for the full year. And currently, because the first half is softer, as your screen shows, it's almost at 80%. But that's how these other businesses, because they are like the Ginger, Ama, Cumin, Tree of Life, these are more like startups, so they have very high growth level. We are projecting a growth level in Ginger going forward, close to 27% for the remaining 6 months of the year.
Right. Puneet, if I can just come in, there are a couple of, usually we don't have these, but as Mangalam is highlighting, there are a couple of deals perhaps in the fray as well. Taj GVK, of course, I mean, in terms of managing some of their properties, you're deepening that relationship, but is there any plan to, it's a joint venture, the GVK Group and Indian Hotels. Is there any thinking that you want to divest that near 26% holding in Taj GVK?
You know, this question, especially Mangalam, has been asking not now, but for the last 3 years. And nothing much has happened. It's related to other subsidiaries too. We are, as a part of Tata Group, we are very good partners for all our partners. We prefer that partnerships withstand any kind of test of time. Having said that, simplification is also very important, and we have been doing simplification. That's how we started simplifying and divesting in certain other businesses. We made Roots Corporation, which has the Ginger and the Cumin brand, as a wholly owned subsidiary. So if anything comes up, if our partners wish to grow more with us, and there are opportunities that come up, then obviously we will try.
That is, for us, that is a yes.
For me also, it's always a yes. Anything which is positive helps the underlying business is always a yes.
So by when should we expect this, Puneet?
But nothing is happening. So
no, I'm just saying, in terms of thinking, obviously it'll happen when it'll happen, but just in terms of thinking.
We can simplify some of these businesses, joint ventures, which we have for 3-4 decades. Let's say one a year, we would be very pleased. And if it's 1 in 2 years, we'll still be pleased.
So Taj GVK, you'll effectively possibly look at selling that 25%, but continue as a managing partner, continue as an operational partner in the business. Is that correct?
See, we are a minority partner, so
Yes.
the decision making is in a joint venture with the governance standards, lies with the board and mainly with Taj GVK. Where we would have a higher say is where we are a majority partner. So I think you picked up on a more difficult one for me to answer. This is not where we hold the majority or controlling stake. Having said that, we just signed up with them for another contract in Bangalore, which will be a very nice Taj branded asset about to open in less than a year's time. And we believe that is really the way forward. The growth in this joint ventures and companies is far more important and relevant than, divesting and investing and reinvesting.
Okay, all right. Strengthening that bond that you'll have. Got it. But you have to keep an eye out whether or not there is that 25% that comes to the market. Let's discuss that later. What about the New York property that you'll have? Is it possible that you'll sell the leasehold rights? There were various reports suggesting $1-2 billion or thereabouts. What's the view out there?
I wish a leasehold could fetch $1 or $2 billion. I think sometimes, we get carried away by reporting or kind of breaking news.
Oh, we are very, very responsible, sir.
I'm not talking about CNBC-TV18 is the publication that wrote that news first, and everybody then started calling. So we had to file with SEBI that there is nothing which is right in that kind of news. But yes, trophy assets are always in demand, and there are people who are willing to pay a price that one cannot imagine. And the Fifth Avenue, New York, that's what makes the Taj the Taj. And having the pier has been a matter of pride. And We have been running it for almost 20 years and see no reason why we should not be running it in the near term or in the mid and the long term too.
So you're not looking to sell your rights in that property, Fifth Avenue. And why should we be there?
101%, I say it on this channel, 101%, we are not looking to sell, but we are not the owner of the asset. We just
Yes.
have a leasehold.
Yes.
And these kind of old contracts come with certain rights for the lessor if they choose to exercise that, which is very difficult because it's a co-op of 80 different high net worth individuals.
Sure.
This is a very difficult option to exercise, but should that miracle happen, then we may not be in this asset. But, you know, miracles don't happen usually, but sometimes they do.
All right, and absolutely. Puneet, just one last question briefly, if I may. You know, it's a different looking Taj, renovated, looking great, range of properties. My question is more pricing. Of course, pricing reflects demand supply. And, you know, there's lean season, busy season, all of that. But if you just generally overall draw a graph, I mean, room tariffs is kind of, you know, it's basically a newer base, but every base is higher than the last one. Have we reached the limits of that, or is that, or this is still, it's still dynamic and it's demand supply still? I mean, just in terms of maybe, I don't know, in your category, what is, if I should use the word affordability, but just your thoughts, Puneet.
See, we are with our very diversified brandscape in all kind of pricing segments. So we address the needs and wants of almost the entire population that would use hotels today. We may not be in all locations, but we are in most locations that are relevant. That's number one. Number two, demand is stronger than supply. You know, in all these discussions in the last 3 years, we said first it was revenge tourism, then they said it was discretionary, you know, the YOLO effect.
Yeah.
Now, why, like Prashant rightly said, the base keeps getting set higher and higher. This is a global trend. This is not just an Indian trend.
But sir, I had a related question. Actually, I'm glad Prashant asked that. Very quickly, 30 seconds because we're hitting market opening. Some people wonder if you've hit your peak margins. And, you know, Mangalam was asking us to check that specifically as well because of exactly what you described, right? The base is really high. And you just told us that in the best case scenario, maybe, you know, second half tariffs could go up to 20,000 average. My question is on margins. Has Indian hotels already hit peak margins, or is there still more scope for growth?
In the last 3 financial years, we have been consistently increasing the margin. And that's again a consequence of growth by contract type and growth by brand. Brands like Ginger and Lean Lux could do margins up to 60%. And luxury, if it does 40% in standalone, then you are doing very well. But the growth in Ginger, the growth in new businesses, the scaling up of these businesses is going to keep increasing the margin. And if the contract type is based more and more on management fee-driven business, then the margins are stable. And if possible, they will keep increasing.
All right, Puneet, great chat as always. We wish you all the best of luck. Third quarter, next 60 days, as you said, right? Operative, and 3Q is more than first and second combined. Appreciate your time here as always, and good luck as you continue to execute at Indian Hotels. Thanks very much.